Hey, what's up, YouTube? This is Crunchy Funds. Sorry, it's been about a week since I got another video up, but this week been kind of busy. But this week we're going to be talking about how I personally screen for stocks, and you can take this and use it on your own or modify it, whatever. It doesn't matter to me. But what matters to me is conveying this information because not everybody really does screen for stocks, especially if you're a long-term investor. Personally, I'm more of a long-term investor, so I always screen for fundamentals. I'll sometimes trade short, do technical analysis, but that's for another video. Today we're going to be talking about how I just personally screen for stocks. So, getting right into it. So, the first thing I always look at is what type of security type it is. So, is it a common stock? Is it a REIT? Is it a ADR, depository receipt? I typically stay away from unit trust funds because typically those are like partnerships, and I don't like that because they're usually taxed a little strange compared to like corporations, and you can actually hit with a large tax bill. So I typically just stay away from those just to minimize my overall tax headache. The next thing we actually get into the company. I care about market capitalization, the free cash flow, and the total cash. So I care about the market capitalization to see the size of the company. Depending on the size of the company, I would then go to the free cash flow and to see if that free cash flow matches the size of the company, or if they have too low free cash flow, and due to like too much debt or bad management policies. So the free cash flow is actually extremely important to me because that to me determines the health of the company, how much extra money are they making compared to their expenses, which is basically directly correlated to the profit margin. And then you kind of want to look at like the total cash of a company. So when I look at companies, I like to see how much cash they're holding on to compared to their market capitalization and compared to their overall free cash flow. You don't want to have a high free cash flow and then have emergency happens and hey, I don't have the amount of cash to pay off this emergency. It's like you having a medical bill, you don't have any money saved up. Yeah, sure, I make a lot of money per month, but I don't have any money to deal with the emergency right then and there. And so that's what I usually look for as the three main, I guess, criteria. And then once that meets the criteria, I'll further dive into the company. I'll look at the profit margin. I'll look at both the quarter and the 12 trailing months average. I look at the operating margin, which is basically just how well can the operation stay in business, how well can they continue producing money. Not necessarily how much they're making on profit, but how much the business can stay alive is what it is. Then I'll kind of look at like what sector it's in. You can actually come down here and just select what kind of sector you want. I typically don't unless I'm looking at a specific sector. I'm trying to compare sectors, sector to sector, I guess. And by the way, this is with Fidelity. The stock screener is. It's pretty good. There could be some improvements made. I would like to be able to, I guess, change the order of this. It is a bit annoying. Maybe I'll call Fidelity and ask them about it later. But overall, it's a pretty good stock screener for what it is. I mean, it's free. I'm just a client of Fidelity. I like Fidelity a lot just because all the research apps have. But beside that point, let's get off topic. Getting back to what we were talking about. So I'll try to decide what kind of sector it's in, what kind of industry it's in, what kind of sub-industry it's in, and kind of compare how that company is doing relative to its peers in the same sector. Because you don't want to compare sector to another sector because that's kind of comparing apples to oranges. But at the same time, when you're comparing sector to other sectors, you can see how well an overall sector is doing. And we can get into that later because certain sectors do better during certain economic environments compared to others. So analyzing the type of sector it's in is important. The next thing I usually look at is the debt to capital ratio. So this is the amount of debt over its debt plus its equities. So this will tell you, I guess, how much how much overall debt is the company taking on relative to its capital, and how easily can they pay it back. So I typically don't like investing in companies that have a very high debt to capital ratio. Typically, I would go from 0 to 64%. I don't like going over this. I think some companies do, because usually if a company is over this, they're usually not very healthy. And anything towards 100%, that's just asking for bankruptcy. I just don't like that. It's just too risky for my blood. The next thing I'll look at is price to earnings ratio. So this is the security price versus the amount of earnings the company is getting. So this kind of tells you if a company is making too little money compared to its price, if it's overvalued, or if its price is too low compared to how much earnings it's making. This doesn't tell you everything, but it kind of gives you a metric on where the company is compared to the market median. So the market median right now is 21.51, which is kind of high compared to historic. Historical is 14 to 16 or something like that. But you don't want to invest into a company. At least me personally, I don't want to invest into a company that has a huge PE ratio. I think, for instance, Netflix, for instance, has a very high PE ratio, and it's just too high for my blood. I think Netflix is 200 and something, whereas Apple is 18-ish, and we can look at that in a second. I think Apple's on this list somewhere, and I'll go through and I'll actually do that. So then the next thing I look at is the price to book ratio, the price to equity ratio. This is basically the security price versus how much amount of assets you have. You typically, so the median for this is about 2. So anything above 2, it might be overvalued, it might be undervalued. Or anything above 2 will be considered overvalued. Anything below 2.08 considered undervalued. Now, this doesn't tell you everything either. It can either tell you the company is in a high growth phase, or it might tell you, or if in case it's very low, it might tell you it's either undervalued or something wrong with the company. And after you do all these metrics, it's important when you finally find that stock you're looking at. That's why you always dive into the 10K reports, because the 10K reports will tell you more about how the management is, what the management goals are, what their risks are, what they're planning on doing for the future. You want to listen on some of the investor relation audios. They usually I think somebody interviews the CEO, and usually they'll answer questions and stuff like that. You participate in those. You want to vote for CEOs. You want to look at stuff like Yahoo Finance to dive deeper into their finances. You want to kind of look at technical analysis, which is what I usually use when I'm entering a position to see if it's a good time, which we can get into that a little bit later. Today we're just focusing on stock screening and how to, start that overall research process into a stock. So the next thing I usually like looking at is the dividend yield, because I am a dividend investor and I like having a dividend yield because it makes me feel like if stock goes down, I'm still earning money back. Sometimes I'll invest into a growth stock. It just depends, but for right now I'm trying to build my dividend portfolio. So I'm very big about dividend and growth of the company. So typically I look for a dividend yield between at least about 1% to about 4%. You don't want to go too high of a dividend yield, because usually those payout ratios are too high for the company, or the company is just maybe something wrong with the company. Typically the median for race right now is about 2.38, which isn't great. But typically I look for a stock around 3 to 4%. I will, however, if the stock has high growth potential, like for instance Apple, sometimes stocks will have 1 to 2%. Usually those are stocks that are paying a dividend, but they're also trying to reinvest money, so they're not trying to pay out too much in dividends. So they're trying to, grow more. So they're trying to increase the price of the stock, which is good. They're trying to reinvest the dividends in the company. So you take your picks. Like AT&T isn't growing much, but they have a high dividend yield, 5% or something. whereas Apple is like 1%. So you have to pick and choose on what you want there. But typically, I won't go over like 5 to 6%. Like that's just getting way too high. Even that's a little high. And then the next thing is, I think I mentioned it earlier, was the dividend payout ratio. Let me see where I am on time. So I am about 10 minutes. Okay. So the next thing I look at is like the dividend payout ratio. So the dividend payout ratio, it just tells you how much they're paying out in dividends compared to their overall retained or compared to their overall earnings. I don't like high payout ratios mainly because it means all their earnings are going towards dividends. Like they're not like reinvesting those dividends. They might be reinvesting some, but they're not. Like, all their obligations are just to the shareholders and their dividends. Like they're going to struggle a little bit with continuing growth at that point, and to me, it's just not a good. It's just not good at that point. They need, and there's a high possibility that they might be looking at a dividend cut soon. So, typically I would like a payout ratio between very low, which is 0 to 20%, and like sometimes high, like maybe we can get to like 70 or 80%, like as a really stable company, like for instance Procter and Gamble. I think that their PE ratio is a little bit high, but whereas like Apple's is like 40%, I think Intel's is like 40%. So those PE ratios are really good because it means like they're only paying, they can increase that dividend even that much further if they ever decided to. But yeah, so that's pretty much it. This is how I start off with screening a stock. I hope y'all enjoyed this. And as y'all can see, when I just sort them by free cash flow, I have like 3 or 4 stocks that I'm invested in up here that I want to get invested in. That it's I personally find, I guess, a good stock, or has good management. For instance, I think Intel's up here, Cisco's a really good company, AT&T's up here, even though I think AT&T's payout ratio is a little bit high. It's like 76%. That's a little bit high. Apple's is like 38. But yeah, so going through all this, I just go through 10K reports. But anyways, I hope y'all enjoyed it. Sorry for the, I guess, stammering on and on. But yeah, hopefully my videos will get better in the future. And I appreciate any subscriptions and any support. I will talk to y'all later.